Hello and welcome back to How About That Crypto. You're watching your daily crypto news and updates in 10 minutes with your host, Bitcoin Stylist on Twitter and Bitcoin Hairstylist on Instagram. Today's news stories are there's more regulatory uncertainty, a lot of stuff happening this week. SEC is expanding their own power, and the interest payments are being attacked by the SEC. They are very active, and we wonder why we hadn't heard anything from them. All that and more, and if you stay till the end, I will tell you my thoughts on regulation and what is needed, because I do believe we need smart regulations. Okay, if you like or don't like the content, please let me know by leaving a comment below or clicking, like and subscribe. If you're watching on Instagram, please click on the link in my bio. That'll take you to the YouTube channel, and then you can subscribe, give me a thumbs up, and tell me what you think. Just to be clear and litigious, this is not financial advice. This is for entertainment purposes only. You can use the information and the links I provide you to do your own research. All right, now let's dive in. New rules for exchanges. There's a new proposal that came last week that weighs in at a grand total of 655 pages. Don't worry, the public has a whole 30 days to read, understand, and respond. Should be fine. CryptoBriefing.com reports the proposal aims to broaden the definition of an exchange to any system allowing buyers and sellers to communicate their securities trading interest. If enacted, the proposal would likely make it impossible for decentralized exchanges to comply with SEC regulations. As regulatory scrutiny from the U.S. government agencies increases, those defending the growing DeFi sector will need to pull out all the stops to ensure sweeping proposals from organizations like the SEC don't crush crypto innovation in the U.S. There's a lot of concern about this new rule, and it seems to be targeting decentralized exchanges, and a decentralized exchange is something that is a place where you can go and there's no humans behind it. It's just it's built to just operate on its own, and you can go and you can trade your crypto in it and you have access to a lot more coins and opportunities than you do on other exchanges. Not all exchanges list all the coins, and so while the rule is targeting these exchanges, it also pours over into any communication protocols, which could be regulated by the FCC or the CFTC, the Federal Communications Commission. And that is the one that basically governs like the internet. And so basically like communication protocols is a big, wide space. And it's making the SEC encroach on other regulatory bodies. And the concerns have also been raised about constraining free speech, since it says in the space, in the writing, in the language, it says that the SEC will govern all communication protocols where buyers and sellers can communicate their interests to buy and sell. Not trade, just communicate their interests, which does definitely sound like a restraint on free speech. So we'll see how that pans out. And due to the expansion into communication protocols, this is a big concern because this is wide sweeping. So I'll keep an eye on this. This is just kind of coming up to the limelight, and it's being brought up by a lot of major influencers on social media, and there are other players involved, like people who utilize these decentralized exchanges, or the companies that created them are being served and investigated by the SEC. And so I'll keep a watchful eye and communicate with you and keep you updated as things go down. Okay, next. Interest accounts for your crypto is under attack. If you earn interest on your crypto, then beware, because the SEC is coming after them. The SEC does not like the fact that you can earn interest on your tokens, because they call that an investment contract, which would fall under their jurisdiction. Bloomberg reports that the exchanges targeted are Celsius, Voyager, and Gemini. Those are the main ones. They've collected more than $40 billion in deposits, and the interest rates that they're paying on that $40 billion are exponentially higher than they are at any bank. So, you know, not to talk about any conspiracy or anything, but just think about $40 billion. Who is being hurt by $40 billion being deposited into these platforms to earn interest instead of depositing them where? In other banks. Now, these accounts are not FDIC insured, and Bloomberg is in the Bloomberg article. I'm going to read you one paragraph here. The companies generally say they make money by lending out the crypto at even higher rates to institutional investors who need the tokens to execute their own trades. But since the firms don't register their products and with authorities, regulators have said they worry that potential risks aren't disclosed to investors. You know, that makes sense. You know, if you're gonna earn interest then on a product, then you should probably know what the risks are. And if you cannot figure the risks out on your own, then they should be provided to you. However, the SEC thinks that you shouldn't have to do your own research. You should be provided with that information. Now, last year, Coinbase received a letter warning the company would be sued if it offered lending products. SEC Gensler tells exchanges to speak with watchdogs about regulation. So basically, Gary Gensler is going out, just come in, just talk to us. And Coinbase went in and talked to them, and they were told that they're going to be sued if they offer a lending product. And then the CEO of Coinbase went on social media and explained how the whole thing went down, and they were basically told that we can't help you with this, but if you do it, you could be sued. So I don't know why he keeps going around telling people to just come in and speak to us. So the firms have said they get no guidance when they do. So that's the simple point. So when they do go in, they're being told that they can't really help you. They don't really have the rules figured out yet, so how can they help them? And okay, so you made it to the end. And this is where I talk about my thoughts on regulations. And I do believe that we do need regulations. It will legitimize the space, but it will also like give people confidence when they're investing so that they know they have a little firmer understanding. You know, if the government creates guardrails for the industry, then a lot more people would feel comfortable, and the big institutional investors, even more institutional investors, would come in once there's some sort of clarity. I do feel like power is being wielded under the guise of investor protection, and as an investor, I don't really feel protected with all this regulation. I feel anxiety and fear over how things are being handled. I do think that, you know, I don't see any clarity at all. All I see is threats, and now a change to SEC power to include any platform that has communication protocols where people express their interest in buying and selling, which does sound like encroachment on freedom of speech. That said, regulations are needed. There are 3 places that I think that we need regulations. They are stablecoins, carbon emissions for proof of work mining, and disclosures by each coin or project. So stablecoins is a coin that is pegged to the US dollar or any other fiat currency, meaning it doesn't go up and down. And they're able to do this by every time that they take in a dollar and they create a dollar coin. Or they take in a euro and they create a euro coin. Now, unfortunately, those companies aren't completely transparent. They're not being audited. They don't have any regulations around them. So we don't actually know if they keep those dollars or if they put them into risky investments, which could cause systemic risk in the crypto market. Now, some people don't believe that, but to me, that makes a lot of sense. So I do think that stablecoins need some sort of regulation, but I think all they need to do is just be super open and transparent, and maybe a percentage of their balance sheet is they can make riskier investments, but it should be maybe like 10% or I don't know. But some smarter people can figure that out. That's what I believe. Carbon emissions for proof of work mining. Proof of work mining, I've talked about in the past, is Bitcoin and right now Ethereum. And that is a super high energy intensive. When you hear about, oh, crypto's bad for the environment, that's not a fact. The fact is that proof of work mining is questionably not good for the environment, but that's only if that energy that's being used is not clean energy. So I do think that proof of work mining operations, at least in the U.S., should have some sort of carbon emissions cap or have to trade carbon emissions like other companies do. And the last thing is disclosures of each coin and project. I do think that providing disclosures and having some sort of mandatory reporting for these coins and projects makes a lot of sense. You know, just being able to launch a coin, unless the coin is created from zero and built out through mining. You know, when people are selling their coins, that does seem to be like they're trying to raise money for their business. And if that's the case, then I do think that there needs to be some sort of regulation on them. However, if you build something and you don't sell the coins and you allow people to mine them or have a way where they come into existence starting at zero so they aren't purchased, then I don't think that's a problem. If you're giving them away, I don't think that's a problem. However, there should be some sort of mandatory disclosures and some sort of uniform method for what those look like. Because right now, the white papers are kind of all over the place. Some people include more information, some include less. So I don't think that's good. And last but not least, which is not a space of where we need clarity, it's the fact that we need clarity now. This is really hurting the industry as everyone's seen the prices are dropping. You know, it's not just the Fed. It is a lot of uncertainty around regulation. And you know, I'm gonna close with this. I can handle the risk of picking the wrong horse in a race. Like if I pick a coin and it doesn't do well, I can handle that risk. But I cannot handle regulatory risk or unfriendly government overreach. I can't handle it because that is so uncertain and it could be sweeping and knocking down all of my investments. And then where is the investor protection? So I'll end with that thought for the day. We're going to get this week started off with a lot of concern about the executive order that's coming. So I'll be keeping a watchful eye on that and report on that as soon as it comes out. So everybody, have a good week, and just remember that the crypto market isn't going anywhere unless the government swats it down. And if it does, then I'm sure there will be a fight on the hands. But I do think that would really hurt prices. So not financial advice, but everyone beware and be vigilant and do not sleep on risk. All right, until next time, I'll see you tomorrow. Hodl on.